is chapter 4. The first section, we're getting towards where in accounting, we would be getting ready for the financial statements. And so in accounting, we did adjusting entries, closing entries. We did a statement of owner's equity business, a balance sheet, and income statement. We're going to do a few extras, but we're doing it all in this chapter, kind of getting ready for the end of the year. So this is our learning objectives. We're going to be journalizing, adjusting entries after we figure out if all our ledgers and subsidiary ledgers work, prepare a trial balance or adjusted trial balance, and then find out our net income before expenses. All right. All right. So ensuring the accuracy of financial statements. We want to make sure these financial statements are accurate. We want managers to be able to make decisions in the future based on these. We also want to pay taxes appropriately, make sure our balances are updated going into the new fiscal period. So it's important that we're financially accurate in our reporting. Depending on what your business is, they might do on 1 month, 3 months, 6 months. Every year, the business has to do this for tax purposes. The fiscal period can end differently. Some city fiscal periods end June 30th, halfway through the year. Some schools end August 31st and start September 1st. You know, there's some, most businesses might end in September or December, go January, December, just depends. This fiscal period, again, is length of time for which businesses summarize information for their performance for that period is going to be called the fiscal period. A fiscal period consisting of 12 months is called the fiscal year. Each business, like I said, determines that. This is what we've done already. All right, we've already journalized transactions. We've posted these transactions. We haven't spent a bunch of time on bank reconciliations. Proving cash is something that we've done. So we got the next thing we want is a subsidiary ledger. So if you remember what a subsidiary ledger is, there's two controlling accounts. We have accounts receivable and accounts payable. There is not an example of accounts payable. They will mention it here, schedule of accounts payable, but the schedule for accounts receivable is the one example they're giving you. They're giving you a ton of information. It's important. If you wanted, I would read these sections, look these sections over. They would help with your learning, I believe. But the schedule of accounts receivable just makes sure all the people that owe us money, this is a list of all the people who owe us money and the total. This $23,515.27 should equal what our balance is in the general ledger accounts receivable. The schedule of accounts receivables controlling account is accounts receivable. That's what they say here. So later on, when we do a schedule of accounts payable, the controlling accounts payable. We want to make sure that these vendor numbers equal what's in accounts receivable. If they do, it's another check number to make sure, hey, we're probably pretty close to being right. If they don't, we want to find out which vendor or two that we maybe have an incorrect number, or maybe accounts receivable is wrong. We want to fix it before moving on. So it's another check way to make sure we're on the right page. So the definition here, again, listing the customer account balances and the totals from all their customers. Again, the schedule of accounts receivable should equal the controlling account accounts receivable balance in the general ledger. This is just talking about the exact schedule of accounts payable. It's the exact same thing, just with vendor account balances that we owe money to. Okay, and the schedule of accounts payable should equal the general ledger accounts payable account. That is the controlling account for schedule accounts payable. So it'd just be a list, and we would remember our headings: who, what, when, the company, Wiley Outdoor for our examples, schedule accounts receivable, or the schedule of accounts payable. It just depends. This is a list of all the people that owe us money, accounts receivable. That number should equal the controlling account. We do the exact same thing for accounts payable. Reconciling a bank statement, and we mentioned this earlier, bank reconciliation is just this way of understanding and making sure our bank balances from what we're keeping track of in our checkbook and in our financial, and with the bank is what we've been recording and making sure we've recorded everything correctly. The bank's recorded everything correctly. So it's just a tool to ensure all our transactions are posted accurately. You might have, so we got a book balance, we got the bank. So the bank says we have this much, this is how much we think we have. We deduct any service charges, any posting errors, interest we might add if there is something like that. It's a little bit different than in accounting one, but you get the idea. It's very all these are going to be similar in the process and the idea behind it. And that's what it says here. The logic of bank reconciliation is identical. Take what you think you have, add and subtract any errors, service charges, or interest, and get our new adjusted. So for this, we are subtracting our service charge. All right, and then any posting errors we'll make sure we correct. So that's how we have, what is that, $34 off this amount. Okay. Well, not 34. It would be, you had $25 and then you add 9. Yeah. Outstanding deposits, then you would have adding to this bank balance, because the balance, remember, outstanding deposits, the bank doesn't have a record of those yet. We deduct outstanding checks that haven't been recorded, or the bank doesn't have access to. Maybe they haven't cashed those checks. So we add deposits, subtract outstanding checks, get the balance. These two balances should equal. And if they do equal, then you have a pretty good idea that what you've been doing is worked. And that's a good deal. So on this, again, the bank balance is here, deduct service charge, add posting errors, and we'll let you know if that's why that would be. Service charge identified in the bank statement should be journalized in the cash payments journal. So we would have to journalize that service charge. It's something we didn't talk about. It'd be, usually it's under miscellaneous expense. Errors here would mean that we want to fix them as best we can. And we do an unadjusted trial balance to show debits and credits equal the accuracy of that general ledger, of all that posting that you do. So this is a lot of transactions, okay, or a lot of accounts. But as long as debits equal credits, we're going to be okay. Okay, that's what we kind of explained. That proof of equality, debits, credits, and general ledger are coming from the trial balance. Where do we get these numbers? From the general ledger. We list all accounts that, even if they have zeros or they're not used yet, we still list them. And then what we're going to do is take this adjusting trial balance, and we're going to record and make entries for what they call adjusting entries. Okay, a trial balance prepared before adjusting entries is called unadjusted trial balance. So the who, what, when is the company, unadjusted trial balances, and the date. These are the list of accounts in the general ledger. These are the balances, and if they don't equal, then we need to fix them. All right, so journalizing adjusting entries. These are adjusting entries. I didn't highlight them, but I mean, you get it. You're going to have to be able to do these. I don't really like them highlighted, so I took them off, because then I can read them easier. Estimate of uncollectible accounts. Grill merchandise inventory is one that sometimes is tricky, and we'll talk about it, because your grills or furniture, your number could go, if it's greater, so let's say I have $5 worth of furniture at the beginning of the year, I have $10 at the end, that means I gained furniture, and I would debit the furniture, the merchandise. If I had $10 worth of furniture at the beginning of the year, and now I only have 2, I would lower furniture from 10 to 2. So one you might debit, one you might credit, depending on if you gain them. Otherwise, usually what we do is we debit the expense, credit the other controlling or the other related account. So the first ones, we're just going to go down in order a little bit. Adjusting entries, allowance for uncollectible accounts is going to be debited. Allowance for uncollectible expense, and allowance for uncollectible accounts will be credited. We debit the expense, and we are going to credit the allowance for uncollectible accounts. Try to keep that up there. Merchandise sometimes sold to customers who are later unable to pay the amount. That's what this allowance for uncollectible accounts that can't be collected are considered to be business expenses. So at the end of the year, we decide how much that's going to be. Okay, so the allowance represents the total amount that is uncollectible accounts receivable. Okay, so all the money we think we're going to collect, we figure out at the end of the year that some of this is not going to be. Wiley estimates 2,210 of its accounts receivable will eventually be uncollected. That's the current balance for allowance for uncollectible accounts is $95.69. So you need to take the 2,210.61, subtract the $95.69, which we already have in there, and the adjusting entry is 2,114. That's what they're telling you here. Okay. Allowance, uncollectible accounts expense is increased. We have to debit the expense. Why? Because any accounts receivable that we think is not going to be collected is going to be a business expense. So we need to debit and we need to record this. So we're going to debit the amount of money that we don't think we will receive from accounts receivable into uncollectible accounts expense. And then we will credit the allowance for uncollectible accounts. So you can see we had 9561. They estimate 2,210.61. We don't want to put that in there because we already have 95. That carries over and is involved in this number. Sometimes you will receive it later. So we take that 95, that's part of this number. So we already have 95 in there. We subtract it to get our new balance. We just got to debit the expense. Merchandise inventory balances can vary, like we talked about. The amount of ending inventory is determined by taking a periodic inventory, meaning remember we talked about periodic, perpetual. They just take an inventory, whether it be with the scanner or if they count hand by hand. They make sure they have a good number for their inventory. Here it says beginning balance of grills was 86,148.68. Then when we took an inventory count at the end of the year, we have more, 89,000 worth of grills. Why is that? You continually purchase throughout the year. Maybe they want to have close to $86,000 to $90,000 worth of grills on hand. But we had 86 throughout the year. We buy and sell, and we end up with 89 left over. So when the grill number goes up, and you can see merchandise inventory grills going up, we have to show that increase in the adjustment. So we have to show a debit to grills, okay, merchandise inventory grills, and then we will dump it. Remember, income summary is the dumping ground. Income summary will be credited that amount. Is that always going to be the same? No. If our number is 86,000 and this was 2, we would subtract 86,000 from 2,000 and we would lower it. But since it's greater, how do you increase the grills inventory? We're going to be debiting when we increase. Conversely, they talk about it down here, the similar entries made for furniture, 3,816 credit adjusting entry reduces the balance. So furniture has 3,816.53 less. How are we going to lower the inventory? We have to adjust it with a credit. And so we dump the remainder into the adjusting entry income summary furniture. So why is one debited, one credit? If we increase, if we gain merchandise inventory of one of the departments, we gain it, we debit the inventory, credit income summary. If our number in merchandise inventory is less from the beginning to the end, if it's less, like it says here, it's a credit, we will lower it. They're just not showing you every example. They're showing you here, but they're not giving you the, all the details. So that's all. So that's why merchandise inventory is debited here and credited here. Here, grills went up. So then we credit income summary. Here, our furniture inventory is lower than at the beginning. It's not bad or good. It's just what it is. And so we want to reflect this with an accurate number of merchandise inventory. With the furniture, we have to lower it, but with grills, we have to increase it. Okay. Supplies adjustment. Usually in the balance, you take at the beginning of the year, and then all the stuff that costs throughout the year, and then we end up with a number that we have going into the next year. The account balance does not reflect the cost of any supplies used during the year, which is an operating expense. The amount ending inventory is determined with periodic inventory, just like we said before, they're counting it. The balance is 7,610. Okay, the estimated cost is that we have left is 2,430. So the difference is what we have to lower. So we debit the expense and credit supplies. Okay, again, you take an asset that had this much money worth of inventory. We do a hard count, a periodic inventory. We find out we have this much. We subtract the difference we have to, because it's lower, we have to credit our asset supplies and we debit expenses. So that's why we do that there in that adjustment. Same can be done with prepaid insurance. These are both assets. The amount that we had at the beginning of the month, the amount of all the premiums paid. Again, we're doing a little, we're not really counting insurance. It's not physical touch, but we look at the amount that's unexpired left over at the end. How much do we have left? When did we buy it? If we bought it in March, we'll have a couple months left over, etc. Okay, the prepaid amount column, the balance $14,000. The estimate of unexpired insurance is only $2,000. So in order to lower our insurance from 14 to 2, we need to subtract those two, as they show here. And it says the balance of prepaid insurance must be decreased. How do you decrease an asset? You credit it, and you debit the insurance expense. So you can see we're debiting expense, crediting the asset, debiting expense, crediting the asset. On the inventory, if the inventory is greater, we will debit it. If inventory is less, we will credit it. And then the first one, debit the allowance, accounts expense, uncollectible account expense, and then credit the allowance. Depreciation expense. We have two listed. Again, they're going through the same talk. This is a little more involved because we might have plant assets, we might have office equipment, we might have store equipment, so we need to talk. So you're going to see a debit to expense for office equipment. You're going to see a debit to the depreciation of store equipment. And then we will credit accumulated depreciation. Again, they talk about physical assets that are used throughout the year. It could be called plant assets. Plant assets are not bought for sale, so they're not like if you own the hat store, they're not the hats. The plant assets are the buildings and things like that. The portion of plant assets that is going to be transferred to expense is called depreciation. You know, farmers buy trucks. They're not worth $50,000 in the second year. They're worth a little less, so you need to depreciate them. But if they're used for business, we will call it an expense, the depreciation expense. We often estimate these expenses throughout the year, and then there's a variety of ways that we can go about figuring out these estimates. What we'll do is we'll help you and we'll show in the work together. To adjust these estimates, we will have to make sure we make these transactions, and we'll show you what we mean by that when we get into the work together. But you can see we have a balance of $14,000 accumulated depreciation of office. We need to keep increasing this balance. Every year we will have depreciation, and then we need to show this expense, this depreciation, because we want to match expenses with revenue, and that's what they're talking about here. And the last part, preparing adjusting trial balance. This is adjusted means we now are inputting all of our adjustments that we just created on this last page. We're going to take all these journal entries that we have, and we're going to make sure we post them, and then we're going to get updated balances, and we're going to put them into our adjusted trial balance. You will add up. It's a little different than our worksheets. We'll add up the debits and credits of this adjusted trial balance, and we will come up with a number. The difference between those two is the income before taxes. We're not adding up the federal income tax. We're going to put all our numbers in from the trial balance. Then we're going to make all those adjustments, update their balances, and post them and put them into there. This is now the adjusted trial balance. We add up the columns as long as we're not taking federal income tax expense or federal income tax payable involved. We just leave those numbers off. We take the two numbers. The difference is the income before taxes. Okay. The trial balance prepared where adjusted entries are posted is going to be adjusted trial balance. We figure out the income before taxes there. And then what we have to do is we have to follow the directions. Here it says 21% income before income taxes. And so we take that number that we had, 82,000 number, multiply it by 21, we get a number All right, so we have 17,338.82 is what our federal income tax is supposed to be. But it says Wiley makes quarterly payments because we are a corporation. We need to pay these quarterly $4,000. So if they pay $4,000 4 times a year, that's 16 grand. They show it here. If we owe at the end of the year 17,000, well, we've been paying 4,000 every quarter. So we don't owe 17,000. We owe the difference between 17,000 minus the 16 that we've paid. So the difference is the 1,382, and that's our federal income tax expense. Debit the expense, credit the payable. Then you go back and put it into the adjusted trial balance, and we would complete that trial balance. These would equal. And again, we'll slowly go step by step to complete that and show you what that's like in our work together. Thanks.